I think the first point to make is that the risks on the earnings numbers, I think, are very much to the upside. And yes, the consensus for S&P earnings year on year, as you say, is sort of close to 25%. I wouldn't be at all surprised if we come out, closer to 30%. Now, having said that, that number has a huge divergence between sectors. So, you have, for example, the energy sector, which spent the first half of last year in an extreme distress. Energy earnings year on year, because of that base effect, are going to be up over sort of close to 300% year on year, but because of the base effect, because of the rally in oil prices. Other sectors such as IT, I think, are almost sort of coming down to being more normalized. So year on year, the tech sector could come out between 10 and 15%. Still a very respectable, strong number. But I come back to my earlier point, which is I think the risk of being wrong for that consensus is that the numbers are going to come out better.
Okay, so noted, look for some more upside, but more short term, there's still a lot of nerves around what plays out with the US 10-year Treasury yield. We've very much come off some of the higher ranges. That said, we've seen very swift movements when the Treasury market does decide to move. We've got data coming up this week. How cautious are you around what has become the #1 theme for many fund managers?
Well, my theme in April was that you would have this sort of consolidation in 10-year US Treasury yields of sort of around 1.7, and we're trading slightly under 1.7 as we talk. I think the key factor is to what extent the Treasury market sells off rapidly, or whether you see a moderate movement. And my thesis for the rest of April and going into May is that we will see higher yields, but the pace is going to be fairly slow. And the reason for that is because the Fed is very much anchored with the Fed funds rate at 0 to 25 basis points. And also they're anchored with 120 billion a month in quantitative easing. Having said that, I stick to my forecast, and single figure forecasts by definition are always going to be wrong. But having said that, I think the 10-year US Treasury yield is going to be close to 2% around the middle of this year. So, a June sell-off in Treasury yields, I think, is inevitable. And obviously one factor which investors are looking at very carefully are the inflation numbers. And this week, the headline month-on-month inflation number, it's going to jump. There's absolutely, I think there's very little evidence to suggest otherwise. So the inflation numbers are going to be trending higher. Real yields are going to be negative. I think investors wouldn't be at all surprised by another sell-off towards the end of this quarter.